The majority of retirees make the same three tax mistakes again and again and again, and I want to make sure you don't make them. So in this video, we're going to cover off the three mistakes and how to avoid them in your retirement plan going forward. The first big mistake is having zero taxable income, and this is especially important earlier in retirement. So a lot of you hit retirement and you might have got a severance package, you might have non-registered money, TFSA money, and you're tired of paying taxes. You've worked for 30, 40 years, and CRA's collected a lot of taxes off you, and you're kind of tired of it. So what you do is you kind of pull back from it all, and you start drawing income from non-taxable sources. And at the end of the year, you owe zero tax, and you have zero taxable income, or very little income. And what happens is, for most of you that have built up RSPs and other taxable income for down the road, is you're just pushing that tax bill down the road. And what it does, we've done hundreds of these plans, and I can show you again and again that you'll just end up paying more tax overall. So while we think short term, hey, we're going to pay CRA less by doing this, the reality is we're going to end up paying CRA a lot more money. So as you build out your retirement plan with your financial planner, make sure to see, look, if I do zero income for a few years and then kind of pile the rest on later on, what's my total tax bill? Versus kind of leveling it out. So make sure to avoid, little income years, because it will make you pay more taxes. We all want to pay less taxes, and while we think we're paying less, it's actually going to be paying more. Now, the only kind of area that this wouldn't apply to is if your income for the rest of your retirement is quite low. Well, then you're going to have a low income throughout. But if you're someone that's built up a bit of assets, you're going to have some taxable income down the road. Make sure to level that out a bit, because having those zero tax years is going to be costly for you. The second big tax mistake a lot of people make is not accounting for multiple sources of income. So as we lead up to retirement, for most of you, you have a paycheck coming in, right? You go to work every 2 weeks, you get a paycheck. They take off the right amount of tax, CPP, EI, all the other deductions that are on there. And typically when you do your taxes at tax time, you might get a little bit back, or you might pay a little bit of tax, but it's going to be very close to what you owe. In retirement is very different, because you go from one income source, your paycheck, to many. And sometimes if you're a household, married, common law, you could have 10, 15, up to 20 income sources. Some are taxable, some aren't. Some withhold tax, some don't. Are you going to get a refund? Are you going to owe taxes? And I always say, personally, I have no problem if I have to pay tax at the end of the year, as long as I know I have to pay tax. I would rather hold on to my money and pay at tax time. Now, I know a lot of you like getting a tax refund. But remember, all that means is that CRA has been holding your money, giving you no interest along the way throughout the year. So you want to do some tax planning, but at the end of the day, your retirement plan needs to show you, when I file my taxes for the year, here's how much tax I'm going to pay. And if it says I have to pay $10,000 of tax, look at how much tax has been withheld on all your income sources. So if you have a pension plan, what are they holding back? CPP, EI if you're collecting that. On your RIF withdrawal, if you have a LIF, all your different income sources, how much tax is withheld on all of those sources of income. And very common in your first couple years of retirement to get a tax refund or owe a lot of money in taxes if you don't plan accordingly. Typically, you're getting a tax refund because there's a larger withholding tax on your RIF account than what you actually owe. And so for cash flow purposes, let's say you only owe $4,000 in tax for the year, but you're pulling out a large amount of RIF. You're doing an RSP drawdown, saving money, taxes long-term, all of that, but the withholding tax is $8,000 and you only owe $4,000. So it's a $4,000 difference in taxes. Now, it's withholding tax. It's CRA mandated. You can't change that. So the reality is you're going to get a $4,000 tax refund. But in the meantime, you're going to see when you build a proper financial plan that that $4,000 of withholding tax is part of your cash flow for the year. So typically what we do is, okay, well, let's pull that $4,000 from a non-registered account, a TFSA account, somewhere else. Use that $4,000 because CRA is holding on to it. You don't have access to it. We need access to it. You're enjoying retirement. We want you to spend that money. So let's pull it from the TFSA. Let's use that money over the year. And when tax time comes, you're going to get a $4,000 refund. We can then put it back into your TFSA and top it back up. So there's kind of this yin yang between withholding tax and how much tax you actually owe, as well as cash flow planning. And that's why as you head into retirement, it's really important to have a non-registered account, a TFSA account, other accounts that you can kind of use as what we call a flex account. Really important as you head into retirement for things like this, things you cannot control around tax and income and cash flow planning. Before I jump into the third one, if you're watching our videos, you're not subscribed, hit the subscribe button, join our community. I know a lot of you watch our videos on ATV and it's hard to subscribe, but there is a way to do it. Or grab your phone, computer, subscribe to the channel. We do release 2 brand new videos every single week around retirement tax and estate planning. So join our channel, we do appreciate it. On to number 3. Leaving a large RSP amount or RIF amount for later in life. So a lot of you start CPP early, OAS, you have a lot of income, and you don't really dip into your RIF account soon enough. And you might say, Adam, no, I've watched enough of your videos, I'm doing it. But maybe you see your parents have done it. Or maybe you've seen a family member, a friend do it, where they get into their 80s, they've just been taking the minimum amount out of the RIF every year, and they have hundreds of thousands of dollars left in their RIF account. And the reality is, sure, if they're married, it'll roll over to their spouse or common law partner. But on second death, whatever's left in those RIF accounts, the LIF accounts, any registered account that's taxable on withdrawal is going to be added to your income in year of death. And that could be a large tax bill. And so there's better ways to do this. Melt down your RSP, spend that money earlier. So there's 2 things to this. Is you have a lot of money later when you can't spend it. That's a problem. We want to spend it earlier and plan for that. But the big tax bill, how do we do better tax planning? We want to get rid of all your taxable accounts by life expectancy, 85 to 87 range. Plan for income beyond that, for sure. But when we create a financial plan in our office for our clients, it's let's make sure all of your taxable accounts are drawn down and eliminated by life expectancy. We'll make sure you have cash flow beyond it. So if you keep living past 85, 87, don't worry, there's income there. But we want to draw it down so that if you do die when you're supposed to, there's not a big tax bill going to CRA. So make sure you do tax planning around your registered accounts so that you melt them down, level out that tax bill, create efficiency around everything. And again, go back to that laddered income strategy we talk about. The go-go phase, which is retirement to about 75. Slow goes from 75 to 85, no goes 85 on. And it's really front loading your plan. Take more cash, more income early. Level out the tax bill, but give yourself more income early. Because that's when you're able to spend it. You're not going to spend it in your 80s. Find someone in your life that's 85 plus. Look at how much money they spend. Unless they're in an expensive care facility, which is few and far between, the majority of people 85 plus spend very little, probably less than their CPP and OAS payments combined. So keep that in mind as you think about tax planning and trying to pay CRA less money and put more money back in your pocket.